Hello, I'm Yvette Jacobs-Lee and I'm a tax partner in our family business sector at Moore Kingston Smith. Well, at the moment, a business, an interest in a business or shares in an unquoted trading company all qualify for 100% relief from inheritance tax by operation of business relief, used to be called business property relief. This is a hugely valuable relief for business owners. But from April next year, 6th of April 2026, that relief is going to be restricted. Each individual is going to have £1 million lifetime allowance for passing on the value of a business. And if the value of your business exceeds £1 million, then inheritance tax at 20% is going to be charged. So we're going from a 0% rate to a 20% rate all overnight on the 6th of April 2026. This is a huge change for business owners, and really this is your call to action to review what it means for you. Well, I think first thing, it's important to recognise whether your business is eligible for the business relief. So it's a relief for trading businesses that are wholly or mainly engaged in trading activities and don't have significant assets that are non-business assets. So some types of business are excluded, and those types of businesses are ones that are wholly or mainly interested in investments, dealing in land or shares. But if that's not you, if you're a trading business that isn't disqualified, then absolutely this change is really important for you. So what we're suggesting that business owners and clients do is review how the shares are held in their business or how those interests in the business are held. Now, for a family business, it might be that the older generation are holding the shares, and we would suggest thinking about diversification of shareholders. Every individual has their own £1 million allowance, so it perhaps no longer makes sense just for the older generation to hold the shares on their own to pass through their wills. Perhaps you need to be thinking about lifetime gifting in your business to make sure that those £1 million allowances are spread around. Now, it's not every family business where direct ownership is going to be the right answer. It may be that holding shares through a trust is right for your business, and these changes apply equally to trusts as they do individuals. The trust will have its own £1 million allowance, and then every 10 years there'll be a trust tax charge on the value of shares, but that's 3% rather than the 20% for shares held individually. And that might be easier for families to plan for rather than a 20% charge every generation on death through wills, a 3% charge every 10 years. So it's all thinking about what's right for your family and how those shares could best be held. As well as the inheritance tax though, we need to think a bit about the capital gains tax. So making a gift is a disposal for capital gains tax purposes. For a trading business, we expect it to be possible to hold over that gain. So that means defer the capital gains tax until the future. You can pass your gain on to the recipient of the shares. But that may or may not be the right thing to do. And so we need to think about it really for each individual family to make sure you're doing what's right for your family and your business. So gifts might not be right for every family business. It's worth saying that if the donor of the gift doesn't survive from 7 years from the date of the gift, and they die after these changes, so after the 6th of April 2026, then there will be an inheritance tax charge. The 100% relief will no longer apply. So for family members who may not survive 7 years from the date of a gift, they may want to consider whether family gifting is the right thing to do. And there's other options that we can consider. I mean, it may be easier to realise the shares that are particularly perhaps a minority shareholder owns, realise those shares for cash and think about gifting with cash, which won't have an unexpected tax charge to fund in quite the same way. So for example, a business might consider a purchase of own shares for a minority shareholder, so using cash in the business in order to realise those shares, and think about inheritance tax planning in a different way. But that again may not be the right answer for your business. Family longevity may be very important in your business, in which case you might be interested in the 10-year instalment option for paying inheritance tax should it fall due. So that could be considered as well. If the next generation don't want to hold shares though, to fund an inheritance tax charge and a capital gains tax charge could get quite expensive. So really we need to plan and understand how valuation of the business might work, and so we can quantify some of these tax charges to help really plan for what the right thing to do is. Another option altogether could be to think about an employee ownership trust. And this is where a business owner can make a disposal of the business into a trust for the benefit of employees. And that disposal can be free of capital gains tax and inheritance tax, where all the conditions are met. And then the business can be held for the future for employee shareholders. So there are lots of things on the table, lots to think about. But I think the key message is now's the time to plan. April 2026 will be here before we know it. And we need to make sure that your business is future-proof for these changes.